Hi, I'm John Stevenson, the Guaranteed Retirement Guy. Welcome to the show. Today, we're going to be talking about what happens to your money if you pass away early, especially if you put it into an annuity contract. So annuities get a lot of flack sometimes because people think, well, if I put my money, if I put the money with the insurance company, they hope that I'm going to die early so that they get to keep my premium. And so therefore, bad investment, right? Well, there are some annuities that will keep your money if you die early. They'll keep all of it. But most of the time, they don't. Okay. I would say 99% of the time when I set these annuity contracts up, I will set them up to make sure that all of your money is yours and it goes back to you if you die early. So it goes back to your estate, goes back to your beneficiaries. There are some annuities that will allow you to elect to not have a death benefit for higher income. I usually will discourage those, but it just depends on what you are looking for. So I'm going to share my screen and I'll compare all of these, but I'll just let you know, usually whenever I sell these, I want to make sure people's principal and everything that they put in is completely protected. So it just depends on your goals and how you feel about leaving your money behind. Okay. So I'm going to share my screen. Let's go over this together. Okay. So if I'm looking at an income rider, income rider attached to a fixed index annuity. This is just someone who's 67, California, $500,000. And right now they could take $39,000 guaranteed every year for the rest of their life. If they, let's say, want to wait till 70, then the income will go higher, of course. I don't know if F&G would be the top one. Oh, they are. Okay. Well, there you go. So F&G is the top one for deferred as well for this particular individual. So that's not always the case. Just so you know, there are different states, different contracts, different ages that we take income and different deferral times. And there are different contracts that are best for each one of those. Okay. So if you want to book a call and you want to talk about that for your situation, there is a link below this video or at my website, johnstevenson.com. Okay. So let's look at F&G and we'll say, all right, well, $50,879 a year, guaranteed income. That's great. Let's look at my death benefit. Okay. What happens if something happens to me? Well, they give you two scenarios, the guaranteed version and the hypothetical version. You might be asking, well, what is the difference? I thought this was a guaranteed contract. It is. But the only thing that's not guaranteed is index values because they don't know what the S&P 500 is going to do. So they're going to give you a portion of the S&P, not all of it, but they're going to give you some of it. But eventually your account balance will go down regardless of what the S&P does. So in the guaranteed side, they show you if there is no credited interest at all during this period, you still get your lifetime income, which is what you bought it for. And you're going to take it out for the rest of your life, as you can see. On the hypothetical, they show that they're giving you just a little bit of the S&P 500, and your account balance here on the left will last a little bit longer, but not much. And so again, this is an income product. This is for pension, and that's why you buy it. You're not buying it for legacy. But if you were to pass away early, okay, this is what this video is about making sure where does the money go if you die early. Look at over here. See the death benefit here? Yeah, that is yours. Okay, that goes to your beneficiaries. So if you were to pass away, it's going to go to your beneficiaries. Okay, so you're not going to lose your money. Now, if you use up, your money, by taking income, then of course there's going to be no death benefit after a certain amount of time. So you can see though, if you take it early, it does reflect the amount that's in your account balance. Okay. So if you decide though, you're taking income and that's what you bought it for, after 10 years, it's pretty much gone, right? You've taken all the money out. But this is a pension and it gives it to you for as long as you live. So if you live till 96, you're going to take out almost $1.4 million. Yeah, pretty good. So that's why you buy it. But you have to know that in any of these income riders, okay, and they are usually the ones that give you the highest lifetime income, they always have a death benefit. Okay. And this is confused. People get confused by this. They think, oh, that money's not going to go to my kids. That money's not going to go to my estate. If I die early, it's gone. Not the case. Absolutely not the case. And that's the case for every single income rider that I sell. There's always a death benefit. Okay, you're never going to miss out. And there are different fixed index annuities with an enhanced death benefit that you can also purchase if you want, to be able to, like if you pass away, your beneficiaries will get actually a little bit more than just what's in the account. So those are nice, but they're not really set up for lifetime income. Okay, so those are just different legacy products. All right, so that's with the fixed index annuity. Now I'm going to show you, I want you to see though, here's how you can lose all of your investment if you die early. Okay. So let's go to the SPIA. Now, the SPIA is a single premium immediate annuity. It's the classic annuity contract where you give the money to the insurance company and they give you a pension. And if you die early, if you don't pick the cash refund, you see the cash refund option here? I'm not going to click it. Okay. I'm just going to do a single life, same thing. And I didn't even do a certain period. I could do that, but I'm electing not to do any of that. I just want highest income. That's it. Highest income. And what is the immediate income? Let's just see what that is. Immediate income, Minnesota Life. So they're the highest. That's pretty good. So what are we looking at? That's 32 times 12. That's $39,984. So roughly $40,000 a year in guaranteed lifetime income starting immediately. That's a little bit higher than the immediate payout. If you noticed, not much, but just a little bit higher than the immediate payout on a fixed index annuity. The difference is, though, is you're signing an irrevocable contract. There is no cash value, no nothing. You die in a year, the insurance company keeps every single bit of that money. Okay. So anyways, I just want to go back and say, all right, well, if we look at this fixed index annuity with the income rider and we push it out for 3 years, it's going to give me $50,879. That's pretty good. What will the SPIA do? And again, I'm going to just say no cash refund. So this isn't a very good comparison because the index annuity will give you whatever is left in the account balance. They do not keep your money. So if I go in here and say, well, I want to take it in 3 years. Let's see what that looks like. 4162. Okay, 4162 over a year is 49,944. That is less. That's like almost $1,000 less than the fixed index annuity. Why would you ever choose that? It's just not good, right? Because you get about the same lifetime income, but if you die in a year, the insurance company is going to keep $450,000. So then you say, well, I want a cash refund. At least give me that, right? Let's compare it to the income rider and see what that is with the cash refund. So if I use it for a year, they're going to give back whatever I didn't use to my beneficiaries. That's fair. So I'm just going to keep it out at 3 years just so I can compare. All right, so 3819, that's really the best comparison. So 3819 times 12, 45,828. Now they're saying we will give you lifetime income the rest of your life, no matter how long you live. And if you die early, we will refund the balance to your beneficiaries. But your income is going to be less than the income rider. It's 45,828. Okay, that's like $5,000 less than the income rider. That's why I usually tell people, if you want highest income, do the income rider. Okay, it's just more flexible. And you might decide in 3 years, I'm not going to take income. I'm going to wait another year. With a SPIA, which is now a DIA contract, when you let it defer, you cannot change it. Once you put the money in, it is set. Okay. Now here are some things though that I do like about the SPIA and DIA contracts. Like for instance, if I wanted to say a certain period, maybe I want the income. I don't want a refund, but I want the income to continue for 30 years no matter what. So if I die in 20 years, I want it to continue for the rest of that period, which is 10 more years. Even if it's to a non-spouse, like a child or someone I'm not married to. That's the nice thing with these contracts. Unlike an income rider where it has to be married spouses, with the SPIA and DIA, you can actually set it up when you do a certain period to be able to give the remaining income payments to whoever you wish, a charity, a child, a friend, whatever. All right, so if we look at a 30-year period certain, that'll show you what that looks like. All right, so 2901. So 2901 times 12, it's like 34,812. So less income, but used for different purposes, okay? All right, so let me show you one last product. Let's look at the MYGAs. MYGAs are like CDs. They're an annuities version of a CD, except they're tax deferred and they have a lot of other benefits and they pay more. But if I look at, let's just say the 7-year one. 7-year one with Equitrust, they're going to give you the entire account value, okay? There is no surrender charge. Surrender charge is as if you surrender the contract early, okay? If you decide to surrender it or cancel it, that's the amount you get out, okay? You put $500,000 in, you can see after like 2 years, you're over break even. Right? That's nice. So if you were to surrender the whole thing, you still can take out your 500 plus earnings over that time. But, why do that if you could just take interest out? And so a lot of times what people do is they'll just take interest out of these and live off the interest, or they'll just let it compound. You can see the earnings over here compound pretty nicely over that time period. So if you were to die in like 3 or 4 years, your beneficiaries are going to get the whole account value, $626,000. So that's really nice. So really what I wanted to just kind of bring home here, the only reason I want to create this video is the fact that pretty much all annuity contracts allow you to have a death benefit, allow you to be able to basically give whatever money you did not use back to your estate, back to your beneficiaries. Okay. There are instances where people will choose a no cash refund. Okay, because they just want the highest amount, and maybe the SPIA just pays just a hair higher than the income rider, and they'll choose that. That is fine, but that is not the norm. Most people will have I want a refund, or I want a cash payout, over a certain period. The rest of the income payments to whoever I choose. That's really nice. Or really the most popular is just the income rider. Buy the income rider and you get the highest lifetime income. And if you want to cancel it, take your money out, you can. If you die, the money in there is left as a death benefit. There's just a lot more flexibility to it. So anyways, hope that helps. If you want to book a call and you want to talk more about annuities for your situation, there is a link below the video, goes directly to my calendar, or you can go to my website, johnstevenson.com, search my annuity calculators. You'll see all of the annuities that are available, what they're paying. And then if you want to book a call with me there, you can as well. So anyways, hope you enjoyed the video. If you did, make sure you like, subscribe, share, comment below. I'll be happy to answer your questions. Really, I just want to give you as much value as I can, because when people are searching around for annuities, they're searching around for someone to work with. It's hard to know who to trust. And the easiest way to get information is like book a call with someone, but you don't want to book a call because you don't want to feel obligated to do business with them, especially if you don't like them. Okay. Watch my videos, go through my calculators. And then if you feel comfortable at that point, then book a call. Okay. I'd rather you get all of your questions answered, or at least as many questions as possible answered before you book a call, because then there's not like, you don't feel like I'm going to try to sell you something. I'm not going to try to push a product and say, you need to buy this. When you already know by looking at my calculators, you already know what's there. Okay. So I can't sit there and try to pull a fast one, like a lot of guys do. They'll just product push. Okay. For whatever reason, higher commissions or trip incentives, or maybe their broker dealer only allows that. But for whatever reason, it's not best for the client. It's not a great way to do business, in my opinion. But a lot of guys still do it, and it's not good. So the transparency is really, really important. So anyways, hopefully that you are watching enough of my videos that you're getting your questions answered. Okay. That's really the key for my channel. So anyways, I appreciate you. I really do. Thank you so much. And we'll see you next time.